see you, but yeah, go on.
Well, welcome everyone to our live Q&A, and we'll be together for an hour. So you have plenty of time to ask a question, and it's the usual situation. So if you ask a super chat, you have to pay a little bit. You'll get pushed to the front of the queue. And if you're one of our YouTube supporters, you also get pushed to the front of the queue. And you can always join during the call, and you can always support us during the call, and then you'll get your question pushed to the front of the queue. And obviously I'll be asking you to like as we go along, and also to subscribe, because we realise that a lot of the people that watch this in replay but also live are not subscribers. So presumably you like us enough to watch this YouTube live, so why not subscribe so you don't miss anything. I suspect most of our content will be relevant to you if you enjoy this live stream. So let me just quickly outline what I've been doing this week. I've had two explainers which I did for the community, which is voted for by the community. One of them was about how to risk manage a portfolio. And that's actually a two-stage process, because when you construct a portfolio, you have to think about risk. But even once you're on the road, as it were, and investing, you still have to think about risk. Situations change, prices move, you have to rebalance, and then you have to think about, well, you know, is this consistent with what I want to get exposure to at the moment? And am I still happy with this level of risk? So it's not a one-stop process. You're always having to think about risk. So I was talking about that management over time and how to approach it. I used to work on risk systems when I used to work for investment banks before I went into the front office. So I know quite a lot about it, or certainly how investment banks do it. And then the other question was about delisting of stocks in China, or at least delisting of Chinese stocks on US exchanges, and the effects that could potentially have on those companies, because a lot of the pension crafters are worried about that risk. So there was a whole explainer about it. But anyway, those are available to you if you're a PensionCraft Patreon supporter. And again, you can join our community at any time. There will be a link in the description if you want to do that. So I've got a very insistent cockapoo here who you can smell the treats on my desk. So let me just start with, oh, very good, Ted. Oh, clever boy. So let me just feed Ted one of those treats. Okay, so I see we've got some questions already, and so we'll work through those questions. We have two questions from supporters. The first one is from Hisham, who is a regular watcher. Thank you, Hisham. Who says, "Hey, Ramin," and he's also one of our supporters on YouTube. Thank you, Hisham. Who says, "I'm thinking of using the new Vanguard ESG Global All Cap ETF as the core for my stock allocation." In fact, that's this week's video, which is about global equity exposure. Number of stocks is 4,118. Charge is 0.24%. Does this sound like a reasonable idea to you? Yeah, I mean, the ones which I like are the ones where the fee is around 0.2, something like that. So the global non-ESG one, I think the fee is 0.23. Now, it turns out you can actually make a cheaper version of Vanguard's global all cap by buying a global developed market all cap combined with a global EM all cap, and that's actually cheaper than just buying the global ESG one. So as long as you can get those subcomponents in ESG form, you may be able to replicate your single fund with two funds slightly more cheaply. And certainly for the non-ESG version, you can get it for about 0.15. So it saves 0.08% on the fee, but then you have to rebalance, and it's a bit of a pain. But do I see any issues with that fund? Not at all. You know, I think that would make a perfectly sensible core to anybody's portfolio. And if ESG is what matters to you, then yeah, that would make perfect sense. Okay, next question is from another supporter. Thank you, Adrian Hyman, who says, how does this very brisk and disruptive fourth industrial revolution, robotics, automation, digital AI, 5G, affect stock prices and PE ratios in your opinion? Right, so again, this is a discussion which we had this week in the PensionCraft community, and I think there's there are two very different groups of opinion. The one group of opinion says that the changes we see in technology at the moment are incremental. Now, if you watch videos on YouTube by Robert Gordon, the economist, he thinks that a lot of the really radical technological changes, so that would be things like the light bulb, which means we no longer have to sit in the dark or use the candles. It means we can have a 24-hour society. The light bulb and electricity. Cars, which mean we're more mobile, we can travel long distances very cheaply. The telephone, which ultimately led to other things such as ultimately the internet was really just an extension of that technology. Those are the big technological jumps that we've had. Whereas at the moment, the changes we're seeing are more incremental. So, okay, you've got an iPhone, you can increase the number of megapixels by 5% and then charge a little bit more for it. But is that really radical anymore? Not really. So we're not making huge changes as we were in the 19th century and in the 20th century. Now that's the kind of pessimistic view. Personally, I'm much more optimistic. Maybe it's because I read a lot of science fiction, but I think there are many changes which really are quite radical. AI is one of them, but really the kind of much less sexy name for AI is deep learning, which is itself just a form of regression. But what it lets you do is to do pattern recognition with computers. It's still a long way away from a computer which is sentient, or where you can even talk to the computer and have it understand what you say and respond in a reasonable way. I mean, I won't say the words, but hey, GOOGLE or hey, SIRI, in theory, should produce a Star Trek-like response, but it's far from it. I mean, it's almost a joke how poor those systems are at the moment. A lot better than they were, but still very poor. So I think we've still got a long way to go, but with certain technologies are really promising, and particularly molecular biology and biotech are very interesting. Being able to sequence entire genomes very rapidly, and entire populations we can now sequence and learn a lot about genetics that way, but also how it affects disease and the ability to manipulate genes, because obviously there are ethical concerns there, but I think that ultimately will transform our lives, because it means we can move beyond the current limits of biology as long as we're ethically okay with that. So I think the ethics is probably more of a constraint than the technology. At least that's the way it's going to be. So I think there's a lot to be excited about. In terms of the actual investor point of view, it's going to happen much less slowly than people expect. Much more slowly than people expect, I should say. Because a lot of the things that people expect are based on science fiction. So they thought that we could have driverless cars by this year, but that's not happened, because that's actually a very difficult problem too. We've already seen a couple of Tesla crashes that have been in the headlines, and so I think it's going to be harder than people expect. I think it's going to take longer than people expect. But if you do want to invest in that kind of thing, there are many stocks to do that, and many funds which now try to get ahead of those trends. Scottish Mortgage in the UK, ARK in the US, or anything with the word disruptive in it probably buys into those SF type themes, which I read about as a kid, but many of which have now come true. So how does it affect valuations? Well, it's pushed up valuations massively for the stocks which are supposed to deliver on many of those goals. But so far, many of them have failed to deliver on many of the promises they've made. So I think the real onus is on those companies to deliver now and to generate profits while doing so. That's the difficulty. So I think I wouldn't get carried away with the narrative and pay too much for those companies. That's the danger for people like me who are nerds, who do get excited by the narrative and want to pay too much for it. So if I see a space fund, like SpaceX's ArcX fund, I really want to buy it. I don't care what I have to pay. I just want to give them my money. But when I sit down rationally and think about it or look at the stocks in it, you realize there just isn't that big a space market out there yet. It's going to take a long time for that to develop. And if you do get in early and you buy into the narrative, you could end up paying too much. So that's all I'd say. The PE on those kind of blue sky stocks is very high because the narrative is just so wonderfully compelling. Just avoid having to pay too much. The time to buy those stocks is after a crash. And that's what I'm going to do probably. If there is an equity market correction, when there's an equity market correction, that's the time to buy into those narratives. Not now, when everyone's got spare cash, spare time, and everybody's buying the same thing. So yeah, I'm kind of bullish about those disruptive fourth industrial revolution stocks. So I like it. I like those stocks, to quote somebody else. Right, Arsenio, who says, brilliant name, Arsenio Cornelio Penesi. Hi Ramin, are DeGiro and Interactive Brokers safe platforms for investing? Which parameters should I look at when assessing the safety of my broker? Thank you and greetings from Rotterdam. Lovely. So another Dutch listener, or watcher. Now, when you're looking at those two brokers, generally it's safer to buy a broker or to have an account with a broker that's regulated in your own country, particularly if you're based in Europe. The reason why is the regulations in Europe are very strict. So regulations about capital requirements, about operational risk, about keeping money separate from client money. So if the two get mixed up and there's a default of the company, there may be a difficulty in getting your funds back. And that regulation may not be so tight for international companies like DeGiro and Interactive Brokers. So if you do go for a domestic platform, it may be safer. But they do offer perhaps a wider range of investments and slightly more speculative investments at that, because of the lower regulatory requirements sometimes. So it's going to be not as safe as a domestic platform. Would I worry about the platform risk? Yeah, I think for DeGiro and Interactive Brokers, I would worry about that. So just do your own due diligence, look to see where they're regulated, and just make sure that you're happy about what would happen if the company folded. Because we've seen with the example of Archegos what can happen even when investment banks don't do their due diligence and they take massive losses. Could Interactive Brokers or DeGiro take massive losses if one of their clients made large levered losses? That's the question. And if many of their clients made large levered losses, would they be able to walk away from the table intact? So I'd really be careful about those kind of international brokers. But having said that, there are many pension crafters who are expats who are based in places like Singapore or Saudi or the Far East who choose to use those platforms, who don't have another choice, who are perfectly happy with them. So really you're just going to have to take that risk if you don't have another choice. But if you do have the choice, I'd go for a domestic platform, is what I'd say. So do like our stream, like this, subscribe, and hit the like button. That helps us a lot. And I've just powered up my cockapoo with those phrases. Obviously, when he hears the word like, Teddy, you're so lazy. You're just resting on my leg. Look, you're supposed to stand up. That's it. Over here, over here, over here. If you walk it, that's it. Good boy. Very good. Great. We've got a new YouTube supporter, Cameron. Thank you, Cameron. Moth says, Moth also a supporter on YouTube. Thank you, Moth. Hi, Ramin. How would you hedge against supply side inflation, I guess? For example, it seems like lots of bottlenecks going into chip delivery and just thinking of investing, getting ahead of the curve. Thanks. Well, this has been very well described and covered by the media. So it's probably too late for things like lumber and chips because those are already well described. I spoke to a client recently who, going into the lockdowns, bought cardboard companies or companies which produce cardboard. The reason being that he thought there'd be more deliveries with Amazon and other delivery companies, and he was right. And I think he made a good return on that investment. So if you can possibly think in a kind of second order way and think, well, if the market's opening up again, there's going to be increased demand for transport, and transport will lead to car servicing requirements or tires being replaced on cars or whatever it is, then, if people haven't been using their cars for a while, maybe the batteries are low, so there'll be more demand for batteries. Try and do this second order thinking, because, we've already, once something's telegraphed in the media, it's too late, right? Probably. So that's the way I'd probably play it. But in terms of the supply side inflation, there's very clear signs. If you look at things like PPI, that bits of that, certain sectors are obviously being affected a lot by bottlenecks. But like the Fed says, I think a lot of those bottlenecks are temporary. Companies are very good at filling in gaps of supply, particularly on the service side. So let's imagine that restaurants were understaffed or there weren't enough restaurants because some have closed down. Well, then it'll become more profitable to open a restaurant because they can raise prices. So very quickly what we'll find is that the supply of those services would increase. So I think for certain sectors, there can be a very rapid response to the lack of supply by increasing supply, because it's profitable to do that, to increase supply. In other cases, there are physical constraints as to how much the supply can be increased, and lumber's one of those. You can't just produce the same quality lumber in the same quantities as you could before many mills were closed after the global financial crisis. So I think that's why it's hard to spot these bottlenecks. You have to be able to combine knowledge of the particular impact of the crisis with where the bottlenecks won't be easily fixed. So I think it's not easy to do. But if it was easy, profits would just disappear. So yeah, I think try and do the second order thinking, and hey, if you join us on YouTube, and if you join us on Patreon, we could talk about that on the Slack channel and put our collective minds together and try and think of some bottlenecks and how to play those trades. So new YouTube supporter Cameron Holmes, thank you Cameron, said, I forgot to join before asking my question. Anyway, you've joined now, that's great. What level of protection does the price to book ratio of about 0.9 of MSCI Turkey offer investors? So let's have a quick look at Turkey, because obviously that's quite relevant at the moment. Let me see if I can share my screen, and I'll go for picture in picture and maximize that. There we go. So let's have a look at the Turkish lira first of all, just so that we can see the economic problem straight away. So this is the let me just remove one of these charts. I've also got So we don't want MSCI International. Right, so the lira has lost about 18% of its strength versus the dollar over the space of about 2 months. So very rapid weakening of the currency due to the macroeconomic problems, due to the central bank governor thinking he has to lower interest rates in order to combat inflation, which no other central bank would consider doing. Might be right, but probably isn't. So yeah, that's one of the problems. And if we look, I don't think I have a Turkish equity index. Let's have a look to see if we can find a single country index for Turkey. So major indices, I'm guessing it's not under that. I wonder if we can find single country for Turkey. I'm guessing not. FTSE Turkey perhaps? No. Nope, I don't think I'm going to find it. Nope, not going to have much luck there. But how much of a kind of moat does that low valuation provide? Not much, I wouldn't have thought. The reason why I say that is because these problems tend to be perpetuating in the sense that if there is an equity market sell-off, you get a weakening of the currency and the two feed off each other. And until they address the fundamental problem, which is central bank governance and independence, I don't think that things are going to get better anytime soon. So I don't think there's an immediate solution to their problem, given that the root cause hasn't changed. So I'd still be cautious about Turkey. I mean, if you can weather the volatility and you're assuming that things aren't going to get worse, then it might be worth averaging into a position in Turkish equity. But personally, I'd still be very cautious, because the other thing to remember about Turkey is that they've issued a lot of debt in hard currency and dollars. And as their currency weakens, it's going to be more difficult for companies to service that debt. So it's much more likely we're going to have some kind of credit crunch in Turkey the longer this weakening of the currency lasts. So unless the politicians address this problem, and fundamentally the president addresses the problem, then it's unlikely to change very quickly. So I'd still be very cautious about Turkish equity, despite the valuations being low. But if you are contrarian, you can weather the volatility and you don't bet a large amount, then yeah, it might be sufficient for you. But personally, I wouldn't. So let's go back to questions. And thanks. Thank you very much for supporting us. Those of you who have supported us, and please do like this stream. It helps us a lot. And if you ask a question as a supporter, you'll be pushed to the front of the queue. And if you do a super chat, again, you'll be pushed to the front of the queue. So please do subscribe. You may find our other content interesting. Okay, next question from Fes1KK, who says, "Hi Ramin, I love your channel. Thank you. Is there a way to profit from the bond markets if my long-term view is that rate hikes may be closer and more frequent than generally anticipated?" Well, if you were a professional investor, one way to play that would be via steepeners. And because the way to think of this is that, let me just get this the right way around so that my arm represents the right shape of the yield curve. So I'm assuming that's the right way around. So this is the short end of the curve. That's the long end of the curve. And interest rates at the long end are usually higher than interest rates at the short end. Yeah. And then the central bank controls the short end, and then inflation and growth expectations control the long end. Right. So when the central bank raises interest rates, you get a flattening of the curve. So the short end moves up and the long end stays pretty much fixed usually. So the curve flattens, which means that you'll lose money on the short end of the curve if you're long bonds, and you'll kind of not make or lose much at the long end of the curve. So what you can do is go short the short end of the curve and long the longer duration part of the curve if you're a professional investor. To do that as a retail investor, as normal investors, is much more difficult. You'd have to find a short fund to go short the 1 to 3 year part of the curve, which would give you -1 times returns of those 1 to 3 year treasuries, and you'd go long the longer part of the curve in order to profit from that steepening. So that's one way to do it. Or you could just forget the long end of the curve altogether and just find a fund which is short the 1 to 3 year part of the curve. I know that they exist. I know there are short treasury funds which give you -1 times the returns on treasuries. So I know those exist. So maybe that's another way to play it. But I'm not sure whether they have specific parts of the curve, you know, the 1 to 3 year, 7 to 10 and 15 year plus long end. But if they do exist, that would be the way to play it via steepener. And if you read my book, Financial Bestiary, I talk about steepener trades and flattener trades in that at great length. So if you want to learn about that. I mean, there are other instruments out there which give you exposure, Fed futures, but again, not for retail investors. So that's not an easy way to play it. But you could just do it generally via these short exposure bond funds. I suspect that would work, if you're right. And Adrian Hyman says, what's the better hedge in your opinion, bonds or gold?
Can you move down a bit because you're chopping the top of your head off?
Oh, am I? How's that? Okay. Okay, Ted. More refreshments for you, my friend, because I know you're queued up there. Right. Yeah, you just crunch away, mate. You just crunch away. So, gold or bonds? So, you know, my preference would probably be for bonds. You don't have to take a lot of duration risk with bonds. You can go for the kind of belly of the curve, the 7 to 10 year treasuries, or the kind of shorter end of the curve, you know, the 1 to 3 year part of the curve. So ETFs like SHY would give you the short dated part of the curve, and then intermediate would be IEF, for example, from iShares. Those would give you exposure to the different parts of the curve, and there's more duration risk for the longer part of the curve. So, you know, maybe that's the way to play it. The reason why I say that is because if inflation goes up, generally gold is a very poor hedge. Just plot the rate of inflation year by year versus the returns on gold, and you'll see there's a very poor relationship between the two. Or if you do the same thing for equity and bonds, you'll see that most of the time bonds are a better hedge than gold. Not always, but usually they're a better hedge. And certainly at the moment, they're still negatively correlated with equity. So, you know, that hedge is still working despite what everyone says. And it's very easy to check. Just plot the daily returns of TLT versus SPY, and you'll see there's a negative correlation probably. I haven't done that over the last week or so, but until recently that was true. So I think bonds are probably better, particularly if there's a very large move in equity, if there's a large fall. Another hedge which you might think about might be something like a volatility product, which gives you exposure to VIX futures. There are many of those out there. Look for one which gives you reduced roll cost, because that's one of the drawbacks of VIX futures products, which is that with a strongly upward sloping VIX futures curve, you lose money on the roll, but they have very clever techniques where they minimize that roll cost, and they actually get exposure to different parts of the futures curve based on whether it's a crisis mode or kind of normal mode, as we are now. So that's another way to hedge. Or you can buy put options. There's a whole bunch of ways of getting that hedge, but with put options, the drawback is you have to pay premium. Bonds are kind of special because the government pays you to have a hedge, which is pretty cool. Not much, but pretty cool. Anyway, so
You're still doing it. You need to move down or back or something.
am I still doing it? You see, I can see my head, and I've got loads of room. I think it's your dodgy laptop, Laura, which is cutting my head off. It's just wishful thinking. Laura wants to chop my head off. So back to the questions. Carla Hernandez, another supporter, thank you, Carla, says, thanks a lot for sharing your knowledge. My pleasure. I really like the channel and wish you the best. Thank you very much. Here is my question. How do company earnings affect stock prices? Is there a buy strategy around this? Oh, interesting, right? So what you might think is that, you know, the value of a company is, I mean, the point of buying a company is that it gives you exposure to the earnings of the company. So that's the benefit of buying a company. You get the kind of capital growth due to the earnings rising. So in theory, if a company's earnings improve, the price should go up. That's the theory anyway. But in fact, the relationship between the two is very weak and kind of floppy. So a big driver of equity prices is sentiment. And if people are very bullish, they tend to pay more for the same amount of earnings than if they're bearish, which is what usually happens after a crisis. Obviously, at the moment, we're in full-on bullish mode. People are willing to pay much more for earnings, the same amount of earnings as they were in 2008. You know, in 2008, you'd have been willing to pay 9 times earnings on average for the S&P. Now you're willing to pay 23 times earnings for the S&P. So to answer your question, there is no very clear short-term relationship. And that's why people always think about whether a company is surprised on the upside or the downside with its earnings. So if you do look at earnings reports, you'll see that the company provides guidance for the analysts as to what its earnings will be in the next quarter. Now, this is a kind of game in a way, because let's imagine we've got a company. What would you tell the brokers? What would you tell the analysts? Well, obviously, you try and flatter your actual earnings by saying you'll be a little bit below that, or not too optimistic, because then you'll disappoint. So, you know, obviously the companies will try and downplay what the earnings growth is going to be, and then they'll surprise on the upside and then get a little bit of a fillip with their equity price. So there's a kind of game between the brokers and the analysts and the companies in order to beat expectations. So over a short period of time, I think betting on earnings is not going to be a very effective strategy. Certainly hedge funds do it. Certainly people who live and breathe markets do it. But I think it's very difficult to make money that way, particularly for a small investor. But over a long period of time, if earnings growth is good, usually equity prices track upwards. And conversely, if equity earnings are atrocious, that tends to be negative for prices. But if it's just 1% or 2% above or below expectations, it's not going to make a massive difference. And there'll be other factors which affect the stock price movements. Usually it's to do with narrative as well. So for example, Netflix recently announced that it was failing to get as many subscribers as it did during the lockdown period. Of course, because we can actually get out of the house now. We don't have to sit at home and watch Netflix. And that had a massive impact on Netflix's share price, which fell very sharply. So the narrative is as important as the actual earnings, I'd say. So if you've got a feeling for what the narrative is, maybe that's the way to do it if you are going to do these short-term trades. But really, that's not the way to win. The way to win for small investors is, buy an index, hold it for a long period of time, because that's much harder to manipulate from the professional side. It's very hard for professionals to stop that working or to take that money out of your pocket. Whereas for short-term trades, you'll be up against the big boys and you're probably not going to win the game. So I probably wouldn't do that if I was you. But certainly pay attention to earnings, because ultimately that's the driving force for equity. But don't try and play it short term. I think that's probably not going to work. Okay. So I haven't said it for several minutes, so please do like our stream, subscribe to our channel, because that way you'll get access to our new content when it comes out. We've got a video coming out this weekend on global equity funds, which I think you'll find interesting. I certainly try to make it interesting, and we try to keep our content relevant for investors. So do think about subscribing to our channel, and yeah, just like our stream, because even if you're watching it in replay, because that helps us a lot and it's very easy for you. So let's just check on the number of people who have liked so far. So we have 313 concurrent viewers and only 125 likes. So please do like it. It helps us. And roughly half usually like it. So we're not quite at half at the moment. Please do like it. It helps us a lot. And we'll get back to the questions. And you can also ask us super chat, which will push you to the front of the queue. Oh, we've got one. Exciting. From Leonard Nebelschutz. Thank you, Leonard. But first of all, I'll answer Dag Helga Gunderson, who says some Norwegian institutions recommend higher percentage of equity funds in the portfolio than rule of thumb due to high government supported pensions and social security. Yeah, I mean, the more equity you have, the better. And generally, the less bonds you have, the better over a longer period of time. If you are worried about a short-term sell-off, then that's not quite true. But many of the people I speak to will be investing for decades. So for them, yeah, put as much equity as you can in your portfolio that you're happy to live with. And that way you'll have higher returns. But I guess the government-supported pensions are going to push up equity prices. I guess that's the point you're making, because they're forced buyers of equity, and that should be supportive of the equity market, I guess is what you're saying, which I kind of agree with. Plus, remember, in the US, we've got the fiscal support, which has also pushed up equity prices there probably, and will continue to do so. So, you know, I agree with that broad sentiment, higher equity allocations. And certainly I'm trying to move that way with my portfolio too. So if your circumstances and your risk appetite support it, yeah, I'd agree with that. But if you're the kind of person who doesn't sleep well at night, if you have a lot of equity, then obviously it wouldn't be appropriate for you. So really you've got to find something that you're comfortable with, despite what the institutions are telling you. You know, you've got to find your own way. And that's one of the things I've discovered and kind of learnt myself, which is there's not one way to do it. Everyone's got their own way of approaching investment, and there is no right way. Certain activities are less likely to succeed. Taking incredibly high risks, for example, is likely to wipe you out. But there's a very broad church when it comes to methods of investing. But generally, equity is the best way to go long term. Right, Scott Becker. Do you believe inflation will be as temporary as the Fed has forecasted? The thing is, the Fed has very good economists. They're not perfect by any means. You know, we all know lots of economist jokes, and you know, as a physicist, I personally find economics quite amusing in terms of the accuracy of its theories. But certainly, if anyone's good at inflation forecasting, it's going to be the Fed, because they have a lot of resources and a lot of data, even at the simply because they've got access to such a wide variety of price data. So they have more than probably anyone else, except maybe some institutional investors. So they've got their finger on the pulse. They know what's going on, and they monitor it on a daily basis. And they have people that live and breathe inflation. And so if they say that inflationary is largely going to be something we can look through because of year-on-year base effects, but also temporary bottlenecks, they must have put a lot of analysis into that conclusion. So I do trust them. I do. And I do believe it's going to be temporary as well. How temporary, I don't know. So that's not clear. But the point is that in the private sector, when there is a bottleneck, it's profitable to fill the supply gap. So that's why usually these things get filled very quickly. So that's why I don't think there's going to be a very sustained period when we don't have enough chips to power our cars, computers and so on, because it's profitable to make those chips and to fill the gap. So that's why I'm not particularly concerned about long-term structural imbalances between supply and demand, because I think they will be temporary. I guess, there could be structural things which last longer, but it's very difficult to forecast what those will be. And probably, people will forecast them incorrectly. I mean, I certainly wouldn't have the resources to be able to do that. But personally, I think, it will be temporary. But we'll see. Really, what's the other big change in what the Fed's done is instead of making its policy based on inflation forecasts, with the analogy in the past being that it was like steering a supertanker. It takes a long time to turn the tank around, so you have to look at where the tanker's headed in order to, head inflation off at the pass before it gets there. That's all changed. What they're saying now, the reason why they're doing this average inflation targeting is that, firstly, their models were wrong. Unemployment was at a 60-year low, but we still didn't see wage inflation. And secondly, I don't think they believe those models anymore. So they're just going to act based on inflation that they actually measure, which I think is probably a good thing, because they won't kind of stop recoveries too soon, which is what they tended to do in the past. They tended to raise rates too soon and stifle any kind of recovery and often cause a recession. So I think it's kind of healthy, their new approach. Yeah, and I also think that, fiscal policy is going to help us a lot there in achieving the Fed's goals. That's not formally recognised, but it's kind of implicitly recognised now by the government. So it's interesting to see if that'll stay too. But yeah, I think it'll be temporary. So there's a super chat from Leonard Nebel-Schutz who says, what do you think about the global portfolio 1? 80% stocks in normal mode, 100% in a crisis mode. Oh, I haven't come across that one. Let's just Google that very quickly and have a look at it. Oh, I do like that. So this is like a dynamic allocation portfolio. I'm not sure I can get more details on it. I can certainly try and translate it with Google Translate and see what we get. Not much more detail there. Let me try translating that into English. Oh, here we go. So let me share my screen so you can see what I see and we'll learn together. Here we go. So the Global Portfolio 1 is a rule-based managed mixed fund with a high equity component and a high strategic initial weighting of the equity. So it's invested globally and based on market cap. So it's like a global equity fund, and it doesn't consider valuation when working out the regional valuation. So it's market cap weighted global equity. In normal market phases, the equity is stable within a narrow range. In stress-related market phases, the equity is increased counter-cyclically in 2 stages, up to a weighting of 100%. So this is exactly the kind of behavior that we should use, which is that when equity markets sell off, we buy more. So what do I think of that? Yeah, I assume they've back tested it. And, it's kind of promoting the right kind of behavior. But the triggers they use for that may be problematic. I'm not sure what triggers they use. How they measure the stress would be interesting. Is it going to be based on credit spread? Is it going to be based on volatility, or how much equity markets have fallen? Not clear. But that could be interesting. Yeah, I like that. That's kind of cool. But you know, these kind of automated kind of funds, you know, the cost of that thing is 0.52%. Well, one says 0.52, the other says 0.77, so it's very expensive, when really you could do the same thing, right? It doesn't take a genius to work out that markets are stressed and they should buy more. You could just look at the forward PE. When it falls below the 5-year average, then buy more equity. And that's a lot cheaper than 0.77%. But do I like the idea and the approach? Yeah, I think that's kind of cool. I like that. I like the strategy. Okay, Adrian Hyman says, taking into account forward PE, CAPE and excess CAPE yield, how bad is the bubble at the moment? Well, it's pretty bad, I'd say. We haven't really had equity sell off much. The sort of growthy stocks have sold off, but the broad markets in the US haven't. So we're still at roughly a 23 times forward PE. And if you look at the CAPE, excess CAPE yield, which does take low interest rates into account, that shows that it's getting expensive in the States as well. So it's very hard now to find measures which show that the US is at fair value. There aren't any left, I don't think, which show that. But if we look at something like the earnings forecasts, and this is really interesting, and it's something I noticed this week. I update this spreadsheet now and then when I get a minute. And let me just share my screen so you can see this. Yeah. So hopefully you can see this. Am I sharing? Yes. Good. Now what this is showing is earnings for the S&P 500 from FactSet. The blue line is the earnings, the quarterly earnings up to the present time. So these are the ones that have already been reported. We go up to Q4 2020. Notice how Q1 2021, which is forecast, is roughly the same as where we were before we got the big fall in Q4 2019. Because the first big fall was in Q1 2020. We're already above that in Q4 2020. And Q1 2021 is going to be comparable. But look at the earnings growth in the quarters ahead. Very, very steep. And that suggests that, you know, that's probably a result of the fiscal stimulus and the fact US growth is going to be higher than it would have been if there hadn't been a pandemic. So that's a huge growth rate in earnings. Will that justify the prices that we see now? Probably not. But I suspect what will happen is that prices will just rise. So we'll keep the same price to earnings. If not, we'll see a multiple expansion going into that very strong earnings growth. So that's why I think, you know, that could be really quite positive. And if we look at the year-on-year growth, you can see that Q2 2021, we're talking about a 51% growth in earnings year-on-year. That's huge because of the low baseline 4 quarters previously, but still. It continues after that at 17%, 15%, 12%, 16%. Of course, the brokers are always optimistic, so you have to kind of adjust for optimism. But I still think that's incredible, given that we had 3 quarters of no earnings growth before the crisis, when earnings were flat. So in fact, the pandemic, awful as it was, has actually been the catalyst to push US growth in earnings higher, which is a big deal. So I think that's actually quite a positive outlook for US equity, given the earnings forecast, if they come true. Of course, there's no guarantee that they will, but still, let's be optimistic and certainly something to consider. But is there a bubble? Yeah. But will it pop? Probably not. There certainly isn't a very strong catalyst for it to pop at the moment. And there's certainly reasons to be optimistic still, even though valuations are high. Zakaria says, when an EU-based investor gets exposed to the US and China, say via ETFs on the S&P 500 and the S&P BMI China, how does one decide on which stock exchange to pick and in which currency? Well, if you are going to be investing in equity over the long term, the currency probably isn't too important because earnings growth tends to be what drives equity higher, and that makes equity drift higher in a geometric way. Whereas currency is driven by interest rate differentials, and that doesn't drift over time. So you won't be in a situation in 50 years where the US dollar is, 1,000 times stronger versus the pound than it is now. Generally, amongst developed markets at least, currencies tend to trade within a band, whereas equity drifts upwards geometrically because of earnings growth. And that's why over a long period of time, the drift wins and currency exchange rate changes matter less. So that's why I wouldn't worry too much about the currency choice if you are investing over the long term. In terms of choosing the ETF, the particular ETF or stock exchange, that shouldn't really matter if you're buying an index, because what really matters is what's in the index and the index itself. I guess what you're saying is, would you buy, say, the CSI 300 or say the another one of the Chinese indices like the MSCI A-share index? I guess what you're really saying is which index would you choose? The different indices give you exposure to different things, but the key thing in China, I think, is whether it's state-owned enterprises which are included or not. That seems to be a big driver of return. State-owned enterprises tend to underperform, so that's one thing to consider. In the US, I'd say that it matters less which particular index you choose if it's a broad index. Over a long period of time, usually small caps do better, perhaps. That's certainly been the pattern in the past. So yeah, the index you choose makes a difference, but the exchange probably doesn't make a difference. I wouldn't have thought if you buy a broad index. But yeah, I'd say the nature of the stocks matters more than the exchange itself. So just see what the tilt is, the factor tilt for the particular index. Does it give you exposure to lots of small caps, lots of high value stocks, or kind of cheap stocks, or momentum stocks? What is its factor exposure? And that'll probably tell you what kind of tilt you're taking with a particular index. And in fact, MSCI is very good because it gives a factor breakdown for every single index it has. Does it give you value exposure, momentum exposure, quality exposure? Which are the factors it's implicitly giving you? So that's probably a good way to get a feel for that, Zakaria. How are we doing for time? I think we've got 6 minutes. So there's a super chat here from Chestad, who says, what are the current projections for the S&P 500 returns over the next decade? I think it seems like we may be heading for a lost decade of low returns. It's true that when valuations are very high, usually that means a decade of low returns. So that's probably true. How low depends on which measure you use. And if you use something like excess cape yield, I think the central forecast when I last updated it was around 4% per year, or between just over 4%, 4.5%, something like that, each year over the next decade. If you don't correct for interest rates, then it's much more pessimistic. I think he's actually forecasting negative returns if you use CAPE, is the most likely forecast. But there are huge error bars for those forecasts. So just remember that, because there are all sorts of other factors which could actually improve returns. It's not just about valuation. It's also about things like fiscal stimulus, about monetary policy, whether that's changed, but also what earnings growth is ultimately and what happens to sentiment. So certainly in the moment, sentiment's holding up very well, given what's occurred. And there's no reason at the moment to think that'll change. But certainly valuation, when it's at levels that it is now, you're right. Historically, that's meant low returns. So yeah, I kind of agree with you that it's not going to be like it was over the previous decade, where we've had over 12% returns on the S&P on average every year. That's probably not going to be the true in the future. And in this video I'm just about to make, or just about to publish, the average return I said people should expect for a global equity fund was about 6%, because that's the long-term average that you get. So I think people being a little bit less optimistic is probably a good thing looking ahead. But being too pessimistic as well, I think, would be a mistake. I wouldn't let that stop you from allocating towards equity, for example, because what's almost always true is that equity will give you better returns than bonds. So there's really no alternative. It's a bit of a Tina situation. So that's it for the questions which are for members of the community or supporters on YouTube and super chats. So I finally get to answer in the last 3 minutes one question from the people who haven't been one of the supporters or done a super chat. And I think that's... Here we go. So the first person who's not a supporter who asked a question was Artur Skuch, who says, what would be the best one ETF portfolio in terms of global, diversified, and not having only stocks? Well, I guess it depends which country you're in, because you get different multi-asset funds depending on the country. But let me tell you what I look for. The first thing I look for is low fees, because you don't want somebody else to eat your lunch. And a fee of less than 0.22%, which is what you pay for life strategy, would be a requirement, because you don't want to give away your returns. Secondly, I'd look for very broad global equity exposure without a domestic bias in your stocks. What I don't like about life strategy is it has a 6-fold overweight for the UK, and that's been a massive drag on returns over the last decade. So look for something which is market cap weighted, because that's fairly neutral. The third thing I'd look for with the bond exposure would be maybe hedging the bond currency exposure, because life strategy does that, and it's been very good at keeping the bond part safe, because with bonds the volatility tends to be low and the currency hedge keeps it that way. So those are the kind of ingredients I'd look for. You're going to have to find whether your particular country's multi-asset funds tick those boxes, but the most important box I'd say is the fee box, because you don't want to give away returns to the fund manager. And usually a simple fund is the best one. If it's really too complicated or you don't understand how it works, then it's probably not great. And personally, I'd go for passive rather than active, because active fund managers, I mean, we just see huge amounts of evidence that net of fees, they don't earn their extra fee. Or if you are going to go active, go for something which is cheap and active, like the MyMap funds, or which are from BlackRock, or HSBC's strategy portfolio funds. So yeah, 0.17% is what you'd pay for those, 0.22 for life strategy from Vanguard. That's the kind of ballpark I'd be looking for. So, just look in your own country to see if there's something that satisfies those criteria. Right, so it's just about turned 8 o'clock, so I'll finish there. Remember, you can always join us on Patreon. You can support us on Patreon, and then we have these calls where everybody's question is answered because there are less of you. We only have about 50 people on those calls, and we usually get through all of the questions. And you can chat to us on Slack, and you get your own members only videos, which you decide on. So we vote on which ones are the most popular, and I make a video just for our community. And so, yeah, Slack is a great forum so that we can talk about investment. You can ask questions of the community, of me, and there's a lot of interaction on there, which is really interesting. And we all learn from each other. And of course, you can support us on YouTube. You can just click on join under this video. There'll be a link in the description as well. And thank you all for joining us this evening. Thank you all for liking the video. I appreciate it. It helps us. And please subscribe if you enjoy our videos, because then you'll see whatever we make and be notified. So have a great evening, everyone, and speak to you in 2 weeks' time. And good luck with your investments. Take care.